Okay, again, and thank you very much for your patience with us this morning. As I mentioned, seem to be having a little difficulty getting a hold of our presenter. So what I'm going to do is, uh, first of all, I'm going to go into how you will be able to quote annuity business when you have that opportunity by using the tools we have on the website. And then we're going to look at one of the benefits available of working with Phoenix in doing your income type of annuity rider presentations to your clients. With all that in mind, of course, again, this is Mark Conter with the Messer Financial Group. Happy that you could join us this morning. And as always, just a couple of housekeeping issues. We hope that the phones are muted. Hopefully, even on my own end here, I know I've got a little background stuff going on this morning that I can close that off momentarily. We're going to ask if you have questions. You can use that box again to the right column where it does indicate questions by typing them in, and we'll address those at the end of the presentation. And basically what I had intended to do, just for your information, next Wednesday on the webinar, we're going to show you how to use the tools on this Messer home site for doing different types of quotes. But this morning, since we have this little faux pas going on, I'm going to go ahead and get into using this particular tools that we have for annuities. I'm sorry there, I needed to step away from my desk for just a moment. Okay. What you're seeing here on the screen this morning, that is the Messer homepage. You'll find that, as you see at the very top, our address, simply www.messerfinancial.com, if you've never been over to our home site. And we are sitting right now on the home page, which again is important. Anytime you call in here and you're looking for assistance, perhaps from our producer support team, they may take you to the website. They may ask you to go to this home page so that they can properly direct you to the information you need. So again, this morning, what we're going to do is we're just going to take a look on what we can do on quoting an annuity for your potential opportunities. You'll see here on the right-hand column as we roll down, below the word Quick Links, Quote Engines. Now again, on this tool, once you left-click on it one time, it's going to bring up to your attention the different types of quote tools that we have available. And we're going to, again, next week go over many other tools that are here in greater depth. But today what we want to do is we're just going to focus on what's called the annuity pipe. So what do we've got? 1, 2, 3, 4, 5. The sixth one down is the annuity pipe. And simply, again, one left click, and it's going to open up the form. If you've not worked with us before and never been on our website the first time, you might have to register. It doesn't need you to verify that you're actually a commissioned agent through Messer. It just needs a registration where you'll set up a username and password into the NetTrack 52. So let's just take a situation this morning. You've got a client that's looking at potential retirement in the near future, and we're going to say they have about $250,000 sitting in their retirement plan at their office, and they're wondering what opportunities they may have with those funds. So let's do that. And let's just go today, and this one, let's go to the state of Florida, because I know we have some people who get on here from Florida. And again, we're talking about an individual looking at retirement, so we're going to assume they're right there at that 64, 65 age group. Okay? We're not going to get particular to carriers, although you could if you use the drop-down box. As you can see, you've got the opportunity to quote from any of these carriers that are already posted in the IGO system. But again, that's not going to be our primary focus today. We're just going to go ahead and ask for all carriers. We don't have to get specific to a product name. we're going to look at, in this case, and we'll come back to this, but this first run through, we'll look at deferred annuities that are non-indexed. Again, if you drop down, you can see we have the flexible premium deferred, we have single premium, and we have indexed annuities. So you do have those options. If you've got a client that's particular about the company, or you think they might be, that they want to do business with, and you want to pick out an actual rating before you go in and do a quote, you can do that as well. But again, this morning, we're going to try to keep it simple. Also, all of the other details that you ask for. Anytime you do this, of course, you're narrowing down the opportunities that'll be out there. So rather than do that and pick out all of these different options that you have, just with this basic information, the actual amount of monies you have available, the state that you're doing business in, and the age of the client, that's all you need to quote an annuity. So it can't get any simpler than that. So again, here we're going to now just come down to, we're going to hit View All Results. Now, the way this page is set up to begin with is it's going to show what's going to be considered the first year best rate. So you can see that the top of the screen brings in a product offered by the American National Insurance Company. ANACO is who that is. If you're not familiar with the ANACO, it is one of the carriers we have. We'll talk about contracting and that also, as I always do at the end of the presentation. But if you're not already appointed, it might be one you want to consider. So what you see here, first of all, is the company name and their rating. And depending upon, again, your client, I can always feel safe when I'm talking with my clients with an A and A+, and even possibly a B++. Again, that's just sometimes sensitive to the client. They may not want to even look at anything from a B++ rated company as an A. And if you're asking yourself, well, what the heck is the difference between an A and a B? Normally what it is, it's the financial wherewithal of that company, not meaning that a B company has less value as an opportunity, but just meaning that they probably don't have as much money under management, so they can't be judged to say the results on that to give them the higher rating. So that would be one of the primary reasons this can happen. So again, though, let's talk about American National's product here today, the Palladium Century 7. I had to think there for a moment. I guess I thought I was good at Roman numerals, but I got thrown off a little bit. Anyway, and then it tells you the product type. And that's a flexible premium deferred annuity. They're talking about a first-year rate on this product of 8%. They're telling you that the product has a 1% base. And as you look down on the line of opportunities that are going to come up here, you can see 1111 all the way down. Then all of a sudden you pick up a base of 4. We'll talk about that when we get into it. The guarantee period of that product, in other words, that's going to be based on that first-year rate. That guarantee is only good for 1 year, which is going to produce an annual yield over the life of this annuity of 1.63636. And we're looking at effective dates of this particular offering from the carrier being just the 1st of October. So very, very current. Always keep that in mind. That's one of the things about the annuities. They are being offered by the carriers, and they are influenced by the market and of the market of interest of the Federal Reserve, etc. So they do change. Oftentimes when you do go out there and pick one of these opportunities and work with your client, the piece is always going to have a date on it, basically telling you that this is only good until X date. It will expire because they're building in the fact that rates could go up or down during that window. So you always need to make sure that you're aware of that. You don't just leave your customer out there with information and then the rates change and they come back to you and say, okay, I want to do it. and then you say, oh my goodness, I can't do that anymore because the rates changed. So don't put yourself in that trick bag. Okay, so let's talk a little bit about this particular product. Well, you could, if you wanted to know a little bit about American National. If you don't, you can just go over there with your cursor and you can click on it. And it's going to give you the basic information of where their contact is. There's a code number with the Association for Insurance Companies. So you've got that available, if you should choose that. Okay. Also, again, you've got that rating. This one happens to show the AM Best at A. And it goes into the where you can go to if you want to get additional information on those type of ratings. So if you want to get a little education, there's a little help for you there. All right, so let's talk about the product. And that's what we're going to introduce ourselves to here. Again, it's going to give you a repeat of the rating, and it's going to give you the product name. And it's going to also, again, give you that effective date. It's going to show the states that it's available in. So if you're sitting there on this web with me today and you don't see your state listed, well, then this is not good in your state. And if I would have chose to use your state on my example, this wouldn't have come up. So again, what we used today was the Florida. That's why it's kind of highlighted a little bit there. But you hopefully will find your state in this group. All right, so we're getting a base rate today of 1%, which they're telling us is not available for clients at 65 plus. All right, so that's important too. We went in here on this example and we threw in 65. An annuity is a life product, okay? But unlike a life policy that you may do an illustration on, where the company may advance their age by that date of birth when they're within that 6-month window and age them up. So let's say this guy's birthday is really in January of 1951. He's still 65 today, but if you were doing a life insurance policy, he'd be 66. But in this case, it doesn't matter. It's the age at the time that you're doing the application. No age up, no save age, none of that stuff. Okay, so we got a client that's 65. If he weren't, this product wouldn't have come up the same way as also the bonus itself wouldn't have come up because, again, it's not available to age 65. And the bonus is just based on the 1 year. The yield I mentioned, you know, well, how does that come in? How could that be when you got a 1, and you got a 7, you got 8, and your yield's only going to be 1.636? Well, let's come down here a little bit, and let's go down to the surrender charge area. This gives you a better idea of the product, first of all, because by counting on these years, or these numbers, 12, 2, 4, 6, 8, 10. Okay. So, basically this is going to be a 10-year contract. And what we've just learned looking at the surrender charge is that if your client should make this deposit of this $250,000 and not use the benefit of withdrawals satisfactory to the contract, which we'll mention also in a little while, and let's just say we're only 5 years into it, 1, 2, 3, 4, 5, and they decide to withdraw all their funds, they're being told right up front they're going to be hit with a 10% surrender charge to cash out of that policy. So what's really taking place is if we average out that bonus rate and the bonus over the 10-year time, the true yield on that money would be, again, 1.63636. There are qualifications for age. As you can see here on this particular product, if it were an 81-year-old, you would not be able to write this product. There are qualifications on the minimal amount of deposit. This product happens to want at least $5,000. Again, it shows that guarantee that we had talked about earlier, which is in effect the base rate. It does show that the client is eligible to make free withdrawals of 10% of that annuity value as of the beginning of the contract year. Okay? It's pretty important to recognize. Contract year is going to be year one, not right now. So you don't throw $250,000 in there today and 30 days later say, I want to pull out $25,000. It's going to be available at the beginning of the contract year. So 1 year from now when they hit that, they'd be eligible to do a 10% withdrawal without any surrender charges or fees. Okay? It's a free withdrawal. Again, the surrender charge is when you're actually closing the account. Further, they add to that, for your knowledge, the market value adjustment. And they say, yes, there is one. It's going to be during the surrender period. It will be applied in addition to the surrender charges. In the states where the market value adjustment is not allowed, an excess interest deduction will be applied. These are getting into details that when you would receive the actual policy for this, you would have the specific information to really share in depth with your client. And as you can see, no other additional information. So one particular example with the bonus, putting it at the top because of the nature of that. So again, we hit at the bottom to go back. Again, we have another American National product, just a real quick one. This one happens to be the same coding, except this is a 5. I'm going to open that one up. And the bonus, again, that was the 5. The yield, of course, was less because of the average. But again, 2, 4, 6, 8, 10. It's a 10-year contract. And all the states that it's available to. Back to the results. Okay, let's say you have been working with North American on life business. You like them in general. You'd like to continue working with them. Again, if you're not familiar with them, you can go here. Let's look at their Boomer annuity. Again, it's a flexible premium deferred annuity. We've got a base rate again of 1, and we've got that 5% bonus on premiums. And now look at how it is. Received in the first 5 years. Annuitization bonus up to 5%. The minimum guaranteed fixed account interest is 1. What they mean by that is that this bonus will be spread basically over the 5-year period of time, which is why, in turn, we're going to show a higher yield than we saw before. So as you're not really getting 1 and 5 and 6, you're getting 2 with the guarantee, again being 1 all the time. So they're spreading it out. So it's going to go over 1, 2, 3, 4, 5 years. 1, 2, 3, 4, and 5 years again. It's another 10-year product. Again, our qualifications on age. Minimal deposit is less, so this might be good for someone that wants to start building into an account with that small amount of money available. So again, they give you, and I didn't go over that on the last one, but let's review it on this one, that it's a flexible premium deferred fixed annuity, offering an initial rate guarantee for 1 year. Annuitization of that bonus also is available. The product and the rating information to be believed to be current. Please contact the issuing company again. So it's just the verification. Product information may vary by state and by issue age. So the first time you go in here and you say, I want to work on annuities, you're going to find that there's a lot of work involved on your part, because if you're going to do this with a client, obviously you're going to want to do your homework. So we just basically touched on 2 companies. Here's an offering from Protective. Let's take a look at this because it's got a little different code over here. The ProSaver Secure 1 year, A+ company. Again, your states of offering. It's going to show a 4% yield on that base, but a guarantee of 1. It's 2, 4, 6, 7 years. So this is a 7-year annuity. Again, it gives you qualifying ages. It does have a market value adjustment. Didn't get into particular detail here on this page, but again, if you drill down with this product, with the company, you'll be able to get that additional information. Here's something interesting, though we didn't see on the first one. Some extra riders. It's actually going to allow a client who has this product to make available benefits for nursing home needs with a terminal illness waiver. So accessing those funds at the time of a terminal illness designation will allow them there without paying surrender charges for that. And it also is going to build in an unemployment waiver. And let's see here. In the notes again, aggravated purchase payment will accept without prior office approval. Okay, so what they're telling us here is they'll take $1 million on this, but if you get higher than that, then we have to go back through their administrative offices, a little bit more paperwork, a little bit more due diligence on your part as an agent to prove why the company would want to take on the risk of that particular annuity size. Okay. So that was good. Oh, and I missed that. I'm sorry. I meant to come back here. Let me go on it again. Didn't go into detail, but, and I don't know why it didn't, but this is a single premium deferred annuity. There it is at the top. So, in other words, you can't add on to this product. Minimal deposit was $10,000. That's where you are. Then you'll see we got a few more single premiums, a few more flexible deferred annuities. You'll start seeing now too where what we just ran through on the surrender charges to identify it on these products is really being identified on these additional products as you get down into further details. Let's see who else we have in here. Let's do Equitrust since we didn't trust or didn't kick on one of theirs. This is their Certainty Select 10. Again, giving us what our base rate and yield would be. No bonuses. We can go up to 90 on this one, so that's good to know. Here's a product when you got that 81 plus or 80 plus client that wants to do something. You've got an opportunity here to work with Equitrust. Again, they're telling us in the early stages that they have a maximum premium with a minimal qualifying deposit. And then we have our non-qualified deposits, or qualified and non-qualified being your taxable or non-taxable consequence dollars that you're working through. So you're taking monies that are rolling, in this case, from a 401k that has taxable liabilities down the road. So you're going to do that as an exchange of dollars from the one process of the pension plan or fund that they have it in into this without the customer ever having his fingers on the money, which would make it a taxable situation, to a direct deposit to the carrier. Also, just a little bit of background information on that. Sometimes that can cause a delay in when a policy is issued when you're rolling over funds from, not normally from a 401k or banking type of business to an annuity, but more when you're rolling funds from one annuity to another, that the company that has the money today that's going to lose the money tomorrow is going to be slow, if that's a fair word, in the processing of that and bringing that money back out. Of course, they do have requirements that they have to meet, but it wouldn't be unusual for a carrier perhaps to drag their feet 30 days on getting money out to the next carrier. So just keep that in mind. That's out of your control. You won't find out until you're in the process of doing some type of an exchange and who the carrier is that actually would hold it back if that were to take place. And let's see, what do we got here? Minimum guaranteed rate represents the annual credit rate. The fixed account, the renewal on each of these products can never be less than that rate. Okay, so again, it's the guaranteed rate. Again, we saw that we have that guarantee in a place for 10 years. And again, we have a 2, 4, 6, 8, 10 year product, which had told us in this case up front, because they called it that, the CertainTeed Select 10. Let's see what riders we've got here, okay? And this is an optional rider if it's selected if the contract provisions are modified with the surrender charges changed. Without surrender charge or without MVA. So they can make some adjustments there, but not give them the benefit of the market value adjustment should they need that down the road. After the first contract year, up to 10% again of that value on the previous contract may be withdrawn without any surrender fee or penalty or withdrawal fees. As a systematically or as a single withdrawal option rider death benefit. Upon death of the first owner, the choice of a cash surrender immediately or accumulation can be applied to a payment option for at least a 5-year period or for life. So again, what we can do here is if we have a joint ownership, the choice of a cash surrender at the time of a death could be spread out. So that would either be to help control the funds to the survivor or really in the best interest of the insurance company not to have to turn those funds away today. All right, let's go back over here. Do a new search. Oh, didn't want to do a whole new search. Well, what the heck. Let's go ahead and do a whole new search. Let's do 500,000 this time. And let's pick up the state of Georgia. And just out of interest, let's go with that older individual. They have been retired. They've got these funds. Let's put in our 75-year-old. And again, I'm not going to get any more particular about picking, identifying. I'm just going to go into what can we get for a 75-year-old that has $500,000. Okay, well, look what happened here. That American National product that we saw before had a 6%, popped it all the way up to an 8, came back down, or maybe that was the same because the average yield is the same. So it probably was. I just forgot. I was thinking 6, but it probably was the same product with the same benefit. And that's what I guess it should be because of all these being the same. And let's see what is in here that could be a little different. Well, let's look at the United of Omaha because it's a company you're probably all very familiar with. Might even be doing some of your life or Medicare supplement business or maybe disability even, or even some long-term care with them. They're pretty well-rounded. Let's take a look at their Ultra Secure Plus 7. Okay. Again, our states of benefit, we got our base rate. And we were okay on this one. We hit into that age group because we came in with a 75-year-old individual. Face of it. It's a single premium again. 2, 4, 6, 7, which is what they called it, a Secure Plus 7. And now they're talking about, as you can see, a number of different riders that they're willing to make available. However, you do have to recognize the availability of those riders based on your state of offering. So even though we specified Georgia in this example, this quote is not Georgia specific. It's showing all the states, and it's letting us know that there are areas that could affect that client, and they could find themselves in need of accessing funds. And in those cases, as they've listed, they would have access according to that agreement, again, the percentages, etc., that would be available to them, penalty or surrender charge free. And you can see there's actually quite a few, from the hospital disability to, again, the common terminal illness, death of a spouse and the survivorship needs, perhaps, home damage, as we've experienced with some of the weather conditions that we've had throughout our nation in the last couple of years, necessity of an organ transplant, accessible, and even in the case for those who might access this at an earlier age for unemployment purposes. So some nice little bennies there. Let's see what else we got here. Yeah. And I didn't use the tool, but I'll show you since we are here. If you did want to just modify this search, it's going to take you back to your screen where you had actually done the input, and perhaps you're working with the client at your desk, and he says, "Okay, well let's just change that to 300,000," and I think I'll look at some options. So again, the results are going to be pretty much the same. Now, that kind of just hit on an idea on my part when I talked about breaking this up. It might not be uncommon, and it might actually be beneficial to you and your client due to the nature of the sensitivity of interest rates today. I think all of us are pretty well aware that they've stayed ridiculously low. So what one might do is talk about the 3-bucket rule. And what that's going to be, take this $500,000 and we're going to create 3 different annuities. I'm going to put this money in 3 different buckets. And the reason we're going to do that could be for a number of different ones. Number one, you might want to put some with one company, some with American National, some with North American. But primarily the reasons you would do this is if you wanted to spread it so funds became available at earlier years. So what I might consider, you might take X amount of dollars, especially if the benefits are strong early on. Let's say out of this $500,000, we want to take 200 of it and put it in this bucket here with this company. And again, knowing that we're tying that money up, as I'm going back to it again just to help myself, for 2, 4, 6, 8, 10 years. Okay. So we got 200,000 tied up for 10 years. Maybe we tie up another 100,000 under a guarantee of 8 years. And then perhaps in the 3rd bucket with the last 200,000, we put it into a 5-year. So what we're doing there is knowing that in 5 years, we've got 200,000 that's going to annuitize there for them to either automatically roll it back into the same product, and you as an advisor should try to stay on top of that because you would want to be available to take advantage of making the move now after 5 years, perhaps to a different company. So go back into that 1031 exchange and pull those funds that are in there now and move them. And then when we get 8 years down the road, bang, here comes another one. Move it again. And then, of course, eventually we're going to get to the 10-year. And if you do this in this bucket and laddering type of effect, perhaps you take that 5-year that comes in now and you put it into a 8-year product. And 3 years later, when the 8-year comes in, you put it into a 10-year product. And maybe then 10 years from now, when the 10-year comes in and you're looking at it, maybe the interest rates have changed so much that you want to only do a 3-year product. So you'll be able to diversify those funds for your client, use different methods to help them receive better gains on those funds and the purpose of their use. So the 3-bucket mentality. All right, now let's do something a little different, and hopefully I can do this without losing everything. Here's our home page again. Just as a review, you come over to quick links, you come down to quote engines, left click one time, open it up, come on down to annuity pipe, cursor on the word, click on it one time, drop in 3 bits of information, view results, and start doing your homework. Okay. I think what I'm going to do here, I'm going to close this window off and hopefully not embarrass myself with some background information. Let's see here. Okay. Let's do it this way. That'll simplify it for me. No, to go. I don't like the way that looks. Let's see if I can do this thing. Yeah, there I am. Hello. There we go. All right. So, let's say you call into the office here and you say, hey, I got a client. They've got X amount of dollars. In this case, we're going to work with a 70-year-old individual, single versus joint. You have the option, though, who's got $25,000 and wants to know what type of a guaranteed lifetime income we could do for that client with that $25,000. So, we can run this spreadsheet for you. All you'll need to give us again is 3 bits of information. We want to know their age. We want to know how much money. And then we're going to ask if it's a single or a joint. Doesn't hurt for us to also know whether the funds are coming in under a exchange with qualified or non-qualified funds, but it doesn't affect the results. So this is really a great spreadsheet because what you can see here is with those funds, we can have a lifetime benefit paid to that person right now, starting right now, with a product from Phoenix. That's what this is, the Phoenix product. And it's in gold. That's why it's in gold. It's the best one. Is $1,534. The second best one would be an Allianz product. Now let's just say again that 70-year-old is saying, well, I want to put the money over there, but I don't really intend to touch it until I'm 75. Well, what happens when we look at it at age 75 is we come across, and it's a different product. It's a Phoenix product again, but they're in gold, so they're going to pay the best income for lifetime. That's what this is, lifetime income for a single individual who's at age 70 when we write it, but starts taking it out at age 75. And the second best in this case happens to come over to the Great American Life Company. So the spreadsheet is really exciting because it makes you as an agent, really look strong. Obviously, you don't have to be contracted with all these carriers because you can see some of them don't even get in the game for this particular rider for the guaranteed lifetime income, but it's impressive to your client, and it'll give you that opportunity. So again, this is really good stuff because you could be working with a client on a Medicare or Medicare Advantage plan, recently turning 65, and you ask the question, are you still working? Well, yeah, I'm still working. Well, where's your safe money at? So we're back to that red money, green money presentation that we did a while back. You might not remember it, but it's on the Messer website in the Learning Center. But again, you're asking the basic question because now you want to find out, do they have funds in something like a 401k or a pension type of benefits that are available for you to go ahead and run an income rider guarantee for them to show them if they do nothing else, just take the money as it is today, put it here, this is what they're going to get for the rest of their life. And for a lot of people, that's a lot of security that they're looking for. Again, with what I mentioned in that previous part of the presentation, something you might want to consider is, again, the bucket rule. Because if they've got a substantial 401k, again, you're going to roll it in a fashion to avoid any taxable consequences at the time of the movement of the money. Not when you take the money out. Whenever you start taking the money out, you got yourself a taxable consequence. Anyway, back to the bucket rule. Perhaps what we're going to do here is we're going to have him continue to work with his financial planner and continue to have his investment portfolio because he likes the marketplace, likes to have that risk factor. He's not your very conservative, highlighted on the statements that you'll work on to for suitability, but he's willing to take a little risk, so we're not going to put all of his money in one basket again. Perhaps we just move part of that money over to a guaranteed income rider, and he's just looking for the safety of having perhaps that amount of money for whatever purpose. Not a lot of money, obviously, when we're talking about moving $25,000, which is probably why this is a pretty good example. I don't know what people think, but they expect miracles for some reason when they think that they can put money somewhere and get a great return, knowing that if they take it down to the bank, they're lucky if they get a 0.5%. Anyway, getting off track. This is a good example to show what happens even with that kind of money. And when you look at it, that's really not too bad when you're looking at $25,000 and taking a guarantee where we had about $2,000. So you're getting back your money in 12 years plus, and hopefully you're going to outlive that and make more based on that particular opportunity. And also when we're talking about that amount that you're working with, I mentioned maybe they only need to have $2,000 a year to pay off. I don't know, maybe they could just go on a little short trip one time a year to a certain place in the mountains, and they stay a week, or maybe to the beach, and that's what they're going to use it for. They're just going to pay for a vacation. Maybe they only have a couple of grandkids and they want to have the money come in at Christmas time and spread the wealth to those 2 grandkids. So a lot of different things that you can take into consideration when you get into the sessions with your clients to see exactly what their needs are. And again, what is going to be considered for suitability. Speaking to that issue, when you do get appointed with one of these life carriers, and if that life carrier handles annuities, you're automatically going to have the right to sell annuities through that carrier. But most of them will have a little bit of in-house certification that you'll have to do at their website for suitability, for knowledge that you understand the products and how they work. So that wouldn't be unusual. And it doesn't take long, just so that you're aware of that. That policy won't get issued and you won't be paid a commission unless you do complete that type of certification with that carrier. Okay, let's see what we got here. Oh, thank you. We don't have any questions. making life easier on me. I appreciate that. So again, first of all, thank you all for joining us here at the semester presentation this morning. I'm sorry that we had a faux pas and that our presenter wasn't here, but at least we did give his products, the Phoenix products, a little bit of highlight of information as we used it in the comparison sheet. As I mentioned, next week, please join us again. I'm actually going to again do the presentation next week, and I'm going to use that Messer website, and we're going to talk about other tools there. Particularly, I want to work on the life tools, but I'm also going to get into the Medicare and Medicare Advantage. We're in that season, so I want you to see the tools we have available to assist you there. And as I mentioned also, we're going to talk about your ability to get contracted. Please do that on our website. We'll work on that, but again, it's right there on the Messer website. And I think for this moment, that's all I have today. Look forward to hearing from you or having you on the line with me again next week. Just a last check for questions. Mark Hunter signing off. Thank you.